The headlines are screaming at you, right? They're designed to make you scared. But you know what the antidote to panic is? A plan. And that's exactly what we're going to build today, your personal survival guide. So let's dive in.
Wow, that is a brutal statement, isn't it? And it's designed to be, because for a lot of people, the fear behind those words, it feels incredibly real. But what if I told you that fear is based on, well, a complete misunderstanding of how this game is actually played?
Okay, so before we build our way out of this, we've got to look the beast in the eye. We have to understand what we're actually dealing with. Why does this moment feel so much scarier than just a normal dip in the market? Let's get into the numbers.
All right, check this out. 49%. Now, that number is critical. Moody's has this AI model, and it's putting the odds of a U.S. recession at 49%. So what, right? Well, get this. In 80 years of testing, every single time this model has ticked over 50%, a recession has followed. Every single time. We are literally standing on the edge of a cliff.
And this might just be the thing that pushes us over. The conflict between the US and Iran has taken about 20% of the world's crude oil supply offline. Now, why does that matter so much? Because with just one exception, a big spike in energy prices has come right before every single US recession since World War II.
So you've got the Fed, and they are completely trapped. I mean, they're stuck between a rock and a hard place. If they cut interest rates to help the economy, they risk inflation just taking off again. But if they raise them to fight inflation, they could just push the whole economy right off that cliff we were talking about. Their hands are tied, and that creates the one thing markets hate more than anything else: uncertainty. Okay, so with a backdrop like that, yeah, it is easy to feel panicked. I get it. But this is where we need to take a deep breath, because history gives us a powerful perspective that cuts right through all that noise. The data has an answer for us, but only if we're willing to listen.
And here it is. This is the absolute core truth of investing, right here on the screen. The average bear market, the scary downturns we all dread, they last about 9 months. But the average bull market, the good times, they last nearly 3 years. You see the pattern here? The pain is temporary, but growth has always been the main story.
Just let that sink in for a second. Imagine you put $10,000 into the S&P 500 back in 2000. You didn't add another penny, you just left it alone through the dot-com bust, through the 2008 financial crisis, through the COVID crash, all of it. Today, that 10 grand would be worth over $44,000. The real power isn't about perfectly timing the market. It's about time in the market. It's about having the guts to just sit still.
So the real question isn't if you should invest, but how you should. Look, the right strategy for you depends completely on where you're starting from. So we're going to break this down into 3 simple tiers. Think of it as your personal survival plan. All right, tier 1. If you're just starting out, maybe you have under $1,000 invested, you're actually in an incredible position of power. Why? Because you get to buy everything on sale. Think about it. During the dot-com crash, one of the worst in history, someone who just kept automatically investing the same amount every month still ended up with a 28% return after 5 years. Your action is to start. Automate even $50 a month. Do it today.
Okay, tier 2. This is for folks with somewhere between $1,000 and $20,000. For you, the single greatest danger is sabotaging yourself. The data is so clear on this. The market gains on average 20% in the 12 months after a recession ends. If you sell now and just sit in cash, you are almost guaranteed to miss that recovery. The people who get wiped out aren't the ones who hold, it's the ones who buy high and then panic sell low.
And tier 3 for anyone with over $20,000. Your goal isn't to run for the exit, it's to fortify your castle walls. This is the time to add some shock absorbers to your portfolio. That means rebalancing, shifting a small portion of your portfolio away from maybe some overvalued stuff and into more resilient assets, like high-quality bonds or stable dividend-paying stocks. This lets you ride out the storm without giving up all that future growth.
Now, I know what you're thinking. In moments like these, the temptation to just pull everything out and run to the safety of cash is overwhelming. I get it. But I have to be crystal clear here. That feeling of safety, it is a dangerous, dangerous illusion.
Here's why. With inflation still hanging around 3%, every single dollar you have just sitting in a regular savings account is actively losing its buying power. It's like a slow leak in your tire. You're not standing still, you are going backwards every single day.
I mean, this chart really says it all, doesn't it? Your single greatest weapon in investing isn't picking the perfect stock. It's not timing the bottom. It's just time. The longer you stay in the game, the more the odds stack overwhelmingly in your favor. Cashing out? That's just resetting the clock back to zero.
Okay, so let's tie this all together. Let's build a simple, actionable blueprint. These are the exact steps you can take starting right now to turn all this fear into a massive long-term advantage.
Okay, you ready? Step 1, protect your foundation. Before you do anything else, build up a 3-month emergency fund. That's your safety net. Step 2, automate your investing. Set it and forget it. This takes your emotions out of the driver's seat. Step 3, know what you're buying. Just stick to broad, diversified index funds. You're betting on the entire economy, not trying to find a needle in a haystack. Step 4, rebalance, don't abandon. Tweak your portfolio if you have to, but never, ever exit completely. And finally, step 5, and this might be the hardest one. Stop looking at it every day. Check it once a month maybe. You have to protect your plan from your own panic.
And please burn this next idea into your brain. The recovery does not wait for good news. The market starts climbing back well before the news headlines say the recession is over. By the time it feels safe to get back in, you've already missed the biggest gains. The market always moves first.
And just look at what's waiting for us on the other side of this mess. FactSet is estimating that S&P 500 earnings are going to grow by a whopping 17% in 2026. Buying in now, at today's discounted prices, means you're basically setting yourself up to capture that massive wave of growth when it comes.
So let's end on this thought. A market crash doesn't actually destroy wealth. It just moves it. It transfers it from the people who react with fear to the people who act with a plan. You now have the plan. So the only question left is, what are you going to do?